Okay, right. So this is TYU2, and this is really the only um, what's the word? This is really the I'm just going. This is the next TYU I'm going to do. I'm not going to do 3 and 4. There's no real need. They're just um, different interpretations of the same thing. But this TYU does cover the core elements of associates. So, well, you can come back and do TYU 3 and 4 in your own time as later part of your practice. But this is what's critical. Important point here is the C. Okay, great. So, what do we see here? It says that P acquired 80% of S on the 1st of December. And what I'm going to do is I'm going to focus on the A. The S you're comfortable with. There's nothing new with the S. We've been working on that, but please do finish it up. But the A is what's critical. So P acquired 80% of S on the 1st of December, paying £4.25 in cash per share. So, I mean, this is not new. Your consideration is really, your aim is, and I'll show you, is to find how many shares of S you actually did buy by looking at the share capital of S, and then, if you like, assigning £4.25 for each of those shares. At this date, the balance on S's retained earnings was $870,000. Okay, so that then means you now know what the, in a way, this helps us to find out what the actual net assets at acquisition are, right? Because we know we will be able to see S's ordinary share capital, its share premium, we'll have its retained earnings, we'll have a total, we'll have net assets at acquisition, and then we can move forward. Right, on the 1st of March, which is what was sneaky I felt about this question, on the 1st of March, P acquired 30% of A's ordinary shares. So these shares were acquired sort of 9 months. Well, you've had the shares for 9 months. You've had them, if you look at the year end is the 30th of November 2007. So you've had these shares for 9 months. This just means when you're thinking about the profit for the period, it's not a 12-month period. Remember, with the associates, you get a share of their profits post-acquisition. So your post-acquisition is really a 9-month period. So it says that, but how did you pay for these shares? Interesting here. The consideration was settled by share exchange of 4 new shares of yours for 3 shares acquired in A. So what we need to do is we need to find the number of shares we acquired in A, and then sort of find the ratio that we, if you like, delivered to them. And they tell us what the share price of our shares are, which is £5. So we're issuing shares in our own business to pay. So our consideration is really £5 times whatever number of shares we issued in exchange for their shares. And we need to record that acquisition basically by debiting investment and crediting issue or issuing share capital in our own business, because that's how we have paid for these shares, by issuing new share capital. Right, so these are the events here, PSA, as we can see. Here they all are. So let's just have a look around. And so it's important to look at, that's the share capital of the associate. That's the share capital of the subsidiary. The associate, the subsidiary has some share premium. And then we have all of that as well. And then you have some general information. So let's start walking through this. And I've made some notes here to kind of help me guide us. Let me just, I think I'll just make this all bigger, maybe. Yeah, that's fine. I'll just make this all bigger by, okay, I think that's big enough. So P acquires 80% of S. That's we sort of agreed that, paying £4.25 in cash per share. Now S has a total, so I just sort of highlight this is the subsidiary. S has a total number of 500,000 shares at £1 each. So for the subsidiary, they're telling you P acquired 400,000 of those shares, which is 80%, and he paid £4.25 each for those shares. So that's 80% of 500,000 shares that you've acquired, and you have paid £4.25 each. They tell us, so that means that you paid a total of 1.7 million. Yes, that's what happened here. So you can look at that again. 80% shareholding. They have 500,000 shares. You acquire 400,000, and you pay £4.25 each for those. And that's how you get your 1.7 million. we're then told, so it's good to just have that, because of course you need this, of course, for your working three, your goodwill calculation, right? So all you now need to do is find the fair value of the non-controlling interest, which is the 20%, add those two together, add this thing here with that fair value, subtract what we're going to do next, the net asset acquisition, and you have your goodwill. Anyway, let's carry on. So we then have, so we look at the subsidiary. They tell us, we can see clearly they have ordinary share capital of 500,000, share premium of 80,000, and they tell us they have retained earnings of 870,000. So you can just insert all of these in there. We're told this, we're given this information. We're also then, what I can then do is just look at the financial statements and see the situation at the year end, and I can see that I have this situation here, if you like, 580 and retained earnings of 400,000. So and that's what I have here, 580 and 400,000. Yes, well, and that's what I have. So I can actually have, I can see a fall in post-acquisition events. And that's fine. That can happen, right? So you just have those in there first, and that's what's important. I'll come back to the red bits because that's in the adjustments, but and nothing tricky. Let's talk about the associate. I highlight here, you need to watch for the dates. You acquired them on the 1st of March. Well, not acquired, sorry, your 30% purchase of significant influence, the 1st of March. The year end was the 30th of November. And so we're dealing with a 9-month period, really, of post-tax situation, right? So when you acquired them, or let's look at the year end, the reporting period, you don't have to do it like this, but I'm just really trying to show you if you were doing it, what would happen. Your reporting, end of year reporting period, you have 250,000 in ordinary share capital, retained earnings is 1.2 million. The question goes on to help you by telling you that right at the bottom, A's profit after tax for the year is 600,000. So A had basically 600,000 from the start of the year till the end of the year. So that's here. A's profit for the tax for the year is 600,000. Well, you turned up sort of 3 months into the year, right? Because you had your share there for 9 months, which means that you will only be involved in 9 months of that profit. You will only have access to 9 months of that profit. If you have 9 months access to that profit, that means that you must have acquired them. Not that you need this at all, but just so you know, you need sort of 1st of March, the profits, assuming profits accrue evenly, which we do assume. Retained earnings must have been 750,000 when you acquired them, because between here and here, there's 450,000. So you can take your time to sort of, when I say digest this, sort of look at it and sort of understand exactly what's going on. You didn't even have to do it. You could just have recognized that that's a scenario, that you only be needing 9/12 of that. Okay, right, that's that. Now, what's next? How did you pay? Interesting. How did you pay for A? Well, it says here that you acquired 30% of the shares in A. Okay, not a problem. There are 250,000 shares in A. So if you acquired 30% of the shares, that means that you acquired, 30% times 250,000 shares, right? That means you acquired 75,000 shares in A. How did you acquire them? It says that what you did was, you said to the people in A, we will give you 4 of our shares for every 3 of your shares that we have acquired. So really, you've said, listen, we will give you, just think of the ratio of 3 to 4, so to speak. So you say 75,000 divided by 3 times 4. But in effect, if you look at this ratio, what we're really doing here, right, that's really what I'm doing, isn't it? So I'm saying I'm going to swap, take your 75, I'm going to get 100,000 shares of ours. In effect, I'm going to give you 100,000 shares of ours, and incidentally, each of our shares are worth £5, and therefore we're in effect giving you paper worth £500,000. Therefore, consideration for this 30% share of the associate is £500,000. These journals are just as important as doing any sort of workings, because this is the beginning, if you like, of the argument. So what you then now pay is, you then record your investment in A. You've got an investment, if you like, and by issuing share capital, right? It's a £1. It's important. I always just tend to just go credit capital, but it's important to be able to split that up into the share premium and share capital sort of element, right? Okay, and there we have that. Then, where was I? Yes, so let's come back up here. Let's start looking at some of the adjustments. I'm just going to look at a few of the adjustments, but then, well, when I say look, I'm going to look at all the adjustments, but then focus on the ones that are. So let's look at this one. First of all, we have, it's important to realize this is the 1st of December. Really important to get the dates right. So this is the 1st of December all the way to the 30th of November. So hopefully you start getting used to this. So in your mind you're thinking, plant in the book exceeded fair value of 50,000 in excess of its carrying amount. Plant has remaining life of 5 years to this date. So you nicely go into your working 2. You plunk your 50,000 in there. You can see I put it in red just to be a bit more sort of to stand out a little. 50,000. And what you now have is it's depreciated over 3 years, isn't it? The net book value by the time we get to 3 years is 20 grand ultimately, isn't it? We would have put through 30,000 over the 3 years, if you like. Think of it as one period. It just literally goes from 50 to 20. So you have that, right? We've done a bit of that, and that's how we deal with that one. Right, and that's that adjustment, really, isn't it? For that one. So let's look at the next one. So, this is during the post. Yes, this is a perp. I'm not going to do this one because it's a standard perp. S, but I think I talk about it. So this is a perp. In fact, I think I do it. Let's see. Here we are. Yeah. Here we are. That's it. That's the situation. So this is the parent subsidiary. Subsidiary sold goods to the parent for 400,000 at a markup of 25%. You sold the goods at a markup of 25%. So therefore, technically, the complete markup, if you like, is 80 grand, right? Because when you look at if you sold the goods at 400% at a markup of 25%, that means that 400,000 technically is equal to 125%. And if I wanted to know what the cost, I tend to do mine that way. I like to know what is the cost. The cost is 320,000. Therefore, the 25% is the full perp is 80,000. I just need to ask myself, because I'm teaching this, I'm doing it this way, so you understand what the full situation is. Then I need to ask myself, well, the next question is how much of the inventory is left? So a quarter of the inventory is left. So therefore, the relevant perp that needs to be eliminated is a quarter of 80,000, which is equal to 20,000. Quarter of that is 80,000. Is 20,000. Therefore, the relevant journal, if you like, to deal with this, of course, is to remember it was a subsidiary who sold this inventory. So they are the ones with the retained earnings. So we need to deduct, if you like, the 20,000 from the subsidiary and credit inventory, if you like, and subtract 20 on the face of the statement of financial position, because we're crediting inventory. So I need to come up here and yes, I need to, if you like, deduct another. Oops, sorry, this is the associate I'm in. Need to deduct another 20,000. Oops, sorry, 20,000 for the perp. Yeah, and that of course, this will of course lead to a full-on further 20,000 fall here. So that's how we deal with that adjustment. Right. So you might have noticed a short break there because I was just amending my thoughts on this, on the perp. I just found this sort of, I think, a slightly easier way to discuss it, which is why I did a bit of an edit there. I haven't tried it before. It's interesting how you work with tech, see how this pans out. So let's just go back to that question here. The question here is that, I've lost the question. Right, let's just pull that up very, very quickly, which I can do. Literally taking us back to the question very quickly. Because we're looking at that at the perp. We're looking at the perp. Looking at the perp. Okay. Let's see. It's coming up here. Yes, so let's keep going, and we should see it soon. It's chapter 20, of course, and it is question 2. T1U2. Right, here we are. So the next issue here, it says that in September 2004, A sold goods to P for $150,000. These goods had cost of $100,000. P had a cost of $90,000 still in its inventory at the year end. So let's look at it. Hopefully you've read the question. And I've sort of tried to just break it down. So what happened? September 2004, A sold goods to P for $150,000. The goods cost $100,000. Okay. So P has goods sitting in its inventory. Fine. A, the associate, if you like, has sold these goods, and technically initially it would have recognized a total profit. I mean, I'm cautious with saying PUP, but I'll just say a total profit of 50,000, right? I mean, as that was the markup. A sells goods that costed 100 to this third party at the time. Oh well, whatever. It's an associate. It's a parent. It's not a parent. It's just just P sells it and recognizes all its profit. Now, P still has 90,000 worth of goods in stock, and therefore, with a markup of 50%, the original goods, if it had been a subsidiary, for example, would be held at 60,000. And therefore, when we talk about what that unrealized profit technically is, it's 30,000. So, therefore, the associate is the profit, if you like, on the sale of stock, still held by the parent, if you like, in the retained earnings, is 30,000. I mean, well, that's what the associate is recognizing, a full-on profit of 30,000 in their accounts. That's what I'm saying here. So associate is recognizing, they're recognizing 50,000. We've sold whatever, some of the stock, but there's still 30,000 of stock left with us, but that's fine. They've got 30,000 in their accounts. That's profit. There's no problem at this point. The problem only arises when we now come to do our year-end accounts and when we come to take a share of their profits. So what normally happens, right, is that we take a share of their profits via like working 2 over here. Right, here we are. We take a share of their post-tax profits, which is what we do, and we, if you like, debit our investment with our share of the profits. That's normal. Debit our share of, if you like, remember we're just adding on, and credit income. We say, okay, listen, we have received income from our associate. It's not a problem. That's what we do. But again, the problem here is that some of that income you're receiving is to do with stock you are holding. And that's where the problem is, you see. So what we need to do, I mean, you're only recognizing 30% of that, by the way. This is the point, right? Because you're holding stock. In this income, there's profit from here that's related to stock you're holding, and you cannot sell to yourself. So like I said here, you would be recognizing profit on stock you currently hold, the equivalent of selling to yourself. So it needs to be stripped out, because you cannot recognize profit on stock you sold to yourself. We're not adding the stock to ours. We're not adding their stock to our stock. It's just to do with the fact that we've recognized their profits. In their profits, they have profits relating to stock that we have. So that PUP is, again, like I said, 30% of the. This is the full. 30% is the full thing of the. We only, if you like, that's the ninth. That's 60,000. That's 30,000. That's the full PUP, but we only own 30% of this business. So we can only recognize, we should only recognize 30% of that PUP. And therefore, we have to basically eliminate, so to speak, that 9,000 out of both equations. And therefore, we debit retained earnings, which would be working 5, and credit the investment, if you like, which is the normal thing, which is the investment. And that's how we deal with this, right? So your argument always is to find what the PUP is and literally just debit retained earnings and credit the investment, right? And credit the investment. And that's what's happened here. So let's look at the full thing, kind of dealing with this. So as far as the associate's concerned, you have an investment worth 500,000. Of course, that's what you paid. Your share of the post-ACCA profits, yes, of course, is 30% times 450,000, right? Because that's, you acquired it. The year is 600,000. You have 9/12, you acquired it 9/12 into the year. So therefore, we have profits of 450,000 to work with. 30% of that is 135,000. So, like we said, so that's that. But then in this thing that you've recorded, we have to strip out that 9 grand because it relates to inventory that we currently hold. So that's the 9 grand. So, like you see me doing here, I need to strip that out of those profits, and I do that via the retained earnings. I mean, this is the journal, really. This is the journal here. This is the journal that you see me doing. Right, that's the journal. I'm stripping it out. Right, and then, so in terms of working out the value of the investment now, I now have the investment plus the share of the post-ACCA, less the PUP, and of course they tell us in the question that there's an impairment of 15 grand specific to the investment that we're holding for whatever reason. It's impaired. Markets might have reacted, or whatever it is. Recognize the full impairment, leaving you, of course, with 111 as just the valuation of the sort of income or profits, right? That's 135 minus 9 minus 15. But as a whole, the entire investment, you started off with 500,000. Now you have, if you like, you do all that together. So now you have 611,000. And that's how you deal with that 611,000. Yes. So I think that's kind of the, this doesn't really matter. I think, like I say here, this is the key journal here. I think it's understanding that we technically would have, it's to do with eliminating it from our income that we would recognize. We would recognize this income from the associate by debiting investment with our share of the profits and crediting our income. But again, you have to strip out that PUP that you currently have sitting, and we do it like this. Okay, great stuff. I think the rest of the material, I mean here, I think there was some business here with intercompany business. We don't strip out anything relating to the associate. We only strip out what's relating to the subsidiary. And P had trade payables of 50, S had trade receivables of 50. Strip them out, literally wipe them out. We've done this in the previous chapter. And I think this is sufficient for now. So you kind of finish this through, package the whole thing. If you've gone through this and you've done the rest of the subsidiary and you've done TYU2, I think we can hold and then always come back to TYU3 later on as a practice, maybe over a coffee, and you're just kind of working on it. But the principles we have covered in general on associates, because the main issues were this PUP. In fact, the only issue really is the PUP. And the fair value is not an issue. The fair value we do already in working 2 when net assets are acquisition. But the PUP is, and of course the rules of not stripping stuff out, don't do that, and recognizing any impairment. But work on this PUP and you're there. Okay, great stuff. We'll leave that for now, and we'll return. We will now go back to sort of our chapter 1, chapter 2, and chapter 3, and keep driving through until we get down to the rest. Thank you.